Hey folks, today begins one of several videos that I'm going to produce in the weeks ahead, trying to answer questions that might arise after you've been inundated because you watch excessive amounts of business cable TV programming. And those folks on television have a vocabulary all of their own. And as a little play on words, we all remember reading about fireside chats from our history books that came during one of our nation's darkest times. Well, these chats I'm sharing with you are coming during relatively great economic times. So as a nod to all of us from Florida, I'll call these air conditioning side chats. In my opinion, you should always remember that people on these cable shows are not talking directly to investors like you or me, but rather their commentary and opinions are geared towards sensationalizing the news, number one, to increase viewership and ratings. And I hope you enjoy these videos we're going to produce, and we'll promise not to overload you with too many of them. Now, folks, I'd like to talk to you today about the Federal Reserve and some of the things that you're going to be hearing more and more about on cable TV in the weeks and months ahead as the spring moves to summer and into fall. Today's topic is entitled The Inverted Yield Curve. Now, perhaps a better question for all of us is, what the heck is a yield curve and what makes it inverted? Well, let's start out with the definition of a yield curve. Now, suppose we look at these very primitive drawings that I've put together, and I want you to remember back when banks actually paid something on CDs. Way back when, if you look at this chart we've drawn up, 2-year CDs, let's say, paid 4%. Boy, those were the days. But if you went out 3 years, you got 5%. And if you went out 5 years, you got paid 6.5%. And if you went 10 years, maybe you'd get 7%. You can see from this graph, if you charted these numbers on the graph, it would look like there was a sloping upward angle to the curve if you connected all the dots. That is a normal interest rate, where the longer you tie up your money, the higher the interest rate you would expect to be paid. Now, let's go back to 1981. And I know all of us remember this was a time, sorry about that. Now let's go back to 1981. During the worst post-World War II inflationary times, we had 14% inflation and a very stagnating economy. With all this hitting the Fed at the same time, then Fed Chairman Paul Volcker had to aggressively raise short-term bank rates to the moon in order to kill inflation. Unfortunately, a dramatic rise in rates also killed the economy. Well, here's what it looked like. And again, please excuse my primitive drawings. In 1981, you could have earned 16.5% on a 6-month CD, or you could have bought the 20-year Treasury and locked in 15.25%. Now, a little point of history here. Many of you bought tax-free bonds from us at 15 and 16%, but most investors put their money in a 6-month CD, and it was great until the 16.5% rolled over to 4%. So when you have short-term rates paying more than long-term rates, that's what's called an inverted yield curve, okay? Now, you are going to hear this inverted yield curve term so often it will make you sick. Makes me sick every time I hear it. But I want to tell you what it really means so you can be well armed to keep your emotions intact and keep your investment eye on the ball. Being scared into paralysis by these cable news commentators will not help your investment portfolio, change your income needs, or help you defeat inflation. The key to understanding why the guests on cable TV are acting so dramatically when they use words like inverted yield curve lies in the fact that they're making one critical assumption. Now, it's true that most recessions start after an inverted yield curve. However, not every inverted yield curve leads to a recession. That is key. Let's repeat that. Recessions are generally preceded by an inverted yield curve where short-term rates pay more than long-term rates, but not every time it's inverted does a recession come about. Now, despite all the talk from the Fed about raising rates with inflation running so high, please realize, and I mean to tell you, you got to come to grips with this. The last thing in the world the Federal Reserve wants is to be tagged with actually causing a recession. You might remember back in 2018 when the Fed raised rates and no one was expecting it. There was serious blowback, big time. So they don't want to be blamed for it. So in my opinion, what they, the Fed, will continue to do is to be flexible, giving the future economic uncertainty. And if the economy does slow down significantly this summer or fall, I would look for the Fed to take their foot off the gas pedal of raising short-term rates. Now, where are we today after hearing so much about an inverted yield curve? Well, if you can see this, and I've written something over here, okay? But basically, the 2-year interest rate today is 2.5. The 5-year rate is 2 3/4. The 10-year rate is 2 3/4. And the 30-year Treasury is only 2.87. Now, even if the 2-year became 3%, and therefore the curve was inverted, it really isn't something to get tied up about emotionally. Now, if investors' inflation expectations were really high on the long term, then this 2.87% 30-year rate today would be at 5, 6, or 7, but it's not. So I'm not going to get into the terminology of transitory with you on inflation. But what I'm trying to say is interest rates are still very low, even though they've increased, and the yield curve is basically flat, not something to get overly upset about. Now, I hope I can help you navigate through the never-ending cable news stories that inundate all of us daily. So next time that we get together, we'll talk about the so-called soft or hard landing you might be hearing on the cables, which will occur after the Fed has done trying to tame inflation by raising interest rates. Until then, have a great week.